Dear viewers, welcome to this special episode of People Who Matter. In this episode, I am going to interview people who are in very responsible positions, heads of institutions, the CEOs, the CMDs, in different interviews. For today's interview, I'll be interviewing Mr. Ashish Somaiya, Chief Executive Officer of WhiteOak Capital Asset Management Company. And let's listen to his views on what's happening in India. What should investors keep in mind when they invest their money? This is NRI Money Clinic for you, and I'm Dr. Chandra Kampat, your financial guide for a happy living.
NRI Money Clinic. No hype, just the right advice.
Dear viewers, we have the guest of the day, Mr. Ashish Somaiya, Chief Executive Officer, WhiteOak Capital Asset Management Company, the latest entrance into the mutual fund industry. Mr. Ashish Somaiya has more than 20 years of experience working in the mutual fund industry, finance industry. He's a great orator, a people's man, a person who loves to meet people. And when you hear him, you will be all ears to him. To talk about the WhiteOak Capital, we show here on the screen what WhiteOak Asset Management Company is all about and the group, how much of funds they are handling, all these things, we will show it here on the screen for you. Before he took over in as CEO of WhiteOak Capital, Mr. Ashish Somaiya has earlier worked with Motilal Oswal Asset Management Company. He has also worked with the big names like ICICI Prudential, our mutual fund, a man with very high level of experience in different facets of sales, marketing, product development, talent, grooming, you name it, and he has worked in this. And let me take you through what words of wisdom he has for the investors and our NRI community. Welcome to this episode, Mr. Ashish Somaiya.
Thank you for having me.
Mr. Ashish, my NRI community is asking you the basic fundamental question today. NRIs are global citizens. Why do you think they should invest more in India today than outside of India? What do you have to say for this question of NRIs?
So I think that what you said is, very pertinent to note that NRIs are truly global, So if you are somewhere in the US or Canada or the Middle East or, parts of Asia or wherever you are, considering that most of the places where our NRI friends reside, they are open economies. So, for example, if you are in the UAE, from there through the entire international banking network, they can invest in any part of the world. Same for UK, US, wherever. So it's true that they have access to all global opportunities, and it is also beyond doubt that they must take benefit of all the global opportunities. But even if we were to look at the global investing landscape. And, by and large, my area of concern or my area of expertise has all been related to equity. So even if you look at the global landscape, people invest in equities for growth. Now, which are the engines of growth and which markets or which countries can you, access and whose growth you can capture? So, for example, in last 20 years, China has grown a lot. But very, very difficult to capture China's economic growth through the stock market, because the reality is that the Chinese stock market has not given any return, although the economy has expanded dramatically. So even if one has global access, the point is that one invests for growth, and that growth needs to be easy to capture or practical to capture through the stock market. All economies which give good growth characteristics, their stock markets may not necessarily have the structure, the framework, and the access to be able to capture the growth in stock market terms. Correct? So from that perspective, I think what global citizens should keep in mind is that there are few parts of the world that they must invest in. One, broadly speaking, it is divided into developed world and emerging world. When it comes to developed world, the market which gives the best access and the market which allows you to capture not just their domestic growth, but also global growth, that is the supreme market, that is US. So clearly anybody who is, even if you're a global citizen and you're investing in equities, I think US clearly is one market, right? And pretty much large part of the growth available in the developed world is captured through US. And US markets and US companies have this amazing characteristic that they capture, half of their profitability and growth is attributable to US and other half is attributable to global exposure. Now let's come to so I would say in the developed world, the only market worth investing in any measurable allocation is US. Now come to emerging markets. Within emerging markets, I already told you that the fastest growing country in the last 20 years has been China, but their stock market has not been able to capture that economic growth and the stock market has not rewarded equity investors. So the question is that even if you want to invest in emerging markets, which market has shown the regulatory maturity, the structure, the platforms and the framework whereby the economic growth can be captured in equity markets? I think that's where India comes. The India has this unique advantage and global citizens might realize it even more that people out here in India, most of us have grown up in our B schools and our financial education, reading American books and following American investors. So the Indian market is as advanced and as sophisticated in terms of regulation, technology adoption, and the extent to which India's equity market actually captures the economic growth and allows stock market investors to capture economic growth. See, we invest in equity because you and me cannot be businessmen and entrepreneurs starting every business we are in love with, which means that the stock market should allow us to participate in those businesses and capture their value. And I think structurally, by regulation, by way of technology, and by way of stock market correlation with economic prospects, I think India is right up there. So India is a market, which the future is still ahead of us. The growth is still ahead of us. And I would say in terms of ability to capture return and sophistication and advancement, India is comparable to US in terms of purely the stock market prowess. There are some other markets which are also, right up there or which are comparable, say parts of, I would say, other emerging markets, which give growth which is complementary to India. So India doesn't do too well when oil prices or commodity prices go up. India doesn't do too well, for example, say technology, like South Korea, Taiwan, etc. Do well. So I would put it this way, that global citizens should definitely invest all over the globe, but then which markets provide you the right access, that is crucial. And I think within that, India is right up there. And I think for any NRI, a good part of the portfolio, even if you're investing, say, $100, you might say $50 should be in US, but then definitely $20, $30 should be allocated to India. And my understanding is that everybody's allocation in India is either real estate or fixed deposit, not so much adequately exposed to equity.
Thank you very much for those thoughts, Ashish. One of the hurdles or one of the apprehensions people have in their mind is that we have a general elections which are coming up. They're just a few months away. And right now, there is no clarity which way the results will pan out, whether the present government will continue and government is going to come. They have a dilemma. Should I wait till the elections gets over? Or if I invest now, how will the results of this elections will impact my investment? Do you have any suggestions or any opinions to share on this subject?
Yeah, I think that nobody can predicate any investment based on one particular general election, really. Correct? In the last 25, 30 years, 1990 when India's economy opened, and this entire 30 to 33 years we have seen of India's economic liberalization, I don't think there is any form of government which we have yet missed out on seeing, right? Currently, what is the opposition? They all have had their turn at running India's government. And currently, which is the ruling party, has also spent long time in the opposition. So one is that, the growth has panned out, sometimes slow, sometimes fast. It has panned out across the political spectrum. That is one thing to keep in mind. The second thing to keep in mind is that the India of today is not the India of 10, 20, 30 years back, because today we are a lot more globally integrated than what we were 10, 20, 30 years back. Right? 20, 30 years back, global influence on our economy was limited. The reason why I say global influence was limited is because global investment, the world was not sufficiently invested into India. most sectors were restrictive or closed. Today, across sectors, whether it is real estate, whether it is insurance, whether it is retailing, financial services, commodities, telecommunications, you name the sector and we have varying degrees of, but high level of financial integration and financial investment. What it means is that the government of the day will have to abide by this global integration that we have already enabled over the last 2 or 3 decades. Even if we want, we cannot suddenly get close to business. Right now that we have integrated sufficiently with the globe and we have welcomed with open arms billions and billions of dollars of investment, so we have to abide by our commitments, right? And suddenly a change of government, like we cannot go back to 1977 or 1978 when the government of the day, made it difficult for foreigners to operate in India. A lot of water under the bridge. Last 30 years, the country has changed quite dramatically. So just a change of political party would have lesser influence. So these are 2 larger, framework related things I would share with you. Now coming to the here and now, I would put it this way. By and large, the market, we always try to forecast the market. Sometimes we should also listen to what the market is trying to tell us. The market seems to be sanguine about the election. So market seems to suggest that there is a high probability. And if you look at local research reports, you look at psychologists and political commentators, the market seems to think that there is a high probability of continuity. Say more like 70-75% probability of continuity, which means that there is still 20-25% probability that even if this government wins the election, they might still need to co-opt multiple people for coalition. Now, whether they are in a weak coalition or they are in a coalition with the upper hand, that also matters. And whether they get single majority, that also matters. But all the scenarios that I have read seem to suggest that the market is expecting continuity, and I have till now no reason to believe that we will see anything other than continuity. And the last thing which I would share with you is that if the market gets continuity, let's understand one thing. The market is very happy with last 3-4 years performance of this government. The first 5 years, the first term was full of disruption, and maybe rightly so. But the second term, especially post 2020, the market is very happy with it. So let's not forget that if we get continuity, the market will get significantly re-rated over the next 4 to 5 years. I mean, the next 4 to 5 years, what can happen will get discounted as soon as the election result is over. Correct? So you cannot stay out of the market is the limited point I'm trying to make. And everybody should review, never make an investment or never take a risk which you cannot tolerate. So we are not telling people that they should leverage and put money into stock market. We are not telling people that they should put 100% of their money into stock market. Everybody should be mindful. They should consult you. They should check with you, of course, as their guide and advisor. But everybody should allocate money to equity in a way that it will give them upside. But at the same time, if there was a small probability event playing out, then it should not them throw out of the financial journey or the market. So I think everybody needs to take a risk that they can tolerate. But I think that worrying about one election is just going to postpone progress in the investment journey. You should not get overly caught up with predicting that.
One of the question which is bothering the NRI community is that of late, of course, at no point of time world was a quiet place and everything is hunky-dory, everything is looking good. That phase never comes in the marketplace. One or the other place in the world, there is a turmoil, there is a commodity issue, there is a war-like issue, there is a disruption. Anything happens. But of late, what we are seeing is there is a Ukraine war. It is prolonging. And now, from nowhere, this Gaza war started appearing. And more countries are engulfing itself into it. Do you think these wars or the possibilities of the spinning out of control, or will they have a impact on the Indian economy? Is there anything of a caution that needs to be kept in mind while investing in India? I'm very, very specific to investing in India. The impact of these war-like situations which are happening elsewhere in the world.
One thing to keep in mind is that India is not directly involved or engulfed. So far, if you read anything about geopolitics or if you read any commentary, in fact, by being a neutral party, when it comes to, say, Ukraine and Russia and NATO and the Western world, by being a neutral or a non-aligned party, India is in some way benefited, number one. Number two, it is well accepted that over the next 10, 15, 20 years, India will have a very, very large contribution to the world's economic growth, right? Which means that it is becoming a favored investment destination. And the third thing is that even the unfortunate developments in West Asia, again, India is not directly involved. So the collateral damage for India, always people fear, is mainly related to oil prices. Correct. Otherwise, if you see, it's a domestic inward-looking economy. It is attracting a lot of investment to become a manufacturing hub. We have a very, very strong local and domestic market. By the way, for people who may not recall, even when the Lehman Brothers and the global financial crisis played out, India's stock market reacted, but India's economic growth never really went off track. So these things one should keep in mind. Second is, like I was mentioning, for India, it is always feared that if oil prices shoot up, then how does it impact us? That is what the key thing is. Even in the last month or two, India's stock market has gone nowhere when oil prices started to flare up. Correct. But there also, what we have noticed is that since the time India's software exports have surpassed the oil import bill, correct, and since the time India has started to attract massive foreign investment in the last 2 to 3 years, we are only seeing the market flatlining when oil prices went up. But we have not seen any kind of collapse. See what happened in 2008, what happened in 2013. Comparable to that, nothing has happened. If you see in US, interest rate has gone from practically 0 to 5.5%. But you can clearly see that in India, the market is either range bound or it is giving low single digit return. But we have not seen the kind of collapse that we saw in 2008 or 2013. That is because our external, our ability to handle the external macro, our ability to handle rising oil prices, a lot of those things have improved a lot in the last decade or so. And the last thing I would tell you is that whenever India's stock market declines because of turbulence in the Western world or in the developed world, it has always turned out to be a very big buying opportunity. So as a foreigner or as a non-resident Indian or as a global citizen, whenever you see that decline in US stock market causes decline in India stock market, whenever you see that there is some turbulence because of external environment, you will see foreigners are selling in India, the market is declining. But all of those are always buying opportunities, because ultimately, if our market suffers because of external situations, then it becomes a buying opportunity for everybody out here.
Sir, thank you for those inputs. But the community from outside of India, NRIs, hear about a lot of developments happening. Every day there is a new thing. Every day there is something which is happening, which is a positive. As a fund manager, as an observer of Indian economy, can you list for me 3 things which stand out, which are a path-breaking kind of a developments which have happened in India, which can completely reshape the Indian economy into the future?
See, in my I've been observing, the development of last 24, 25 years. Now, 3 things on, maybe few things which I can highlight to you. See, one thing which has changed, and I tell you specifically, my sister, my brother-in-law, a lot of people in my family are non-resident Indian. Okay. And they've been outside the country for over 2 decades now. So I'm not just taking them as a sample size, but of course, for example, I'm an engineering student. I've done chemical engineering, and all my classmates are in America. I'm probably the only guy in my class who didn't go outside, right? So day in, day out, I am in touch with a lot of non-residents. That is one. Second is, as part of my job, I do travel to Middle East and variety of places, and I do have the opportunity to meet a lot of global investors. For example, WhiteOak, my company, $7 billion we manage. Out of that, $5 billion we manage for global investors. So we do get a lot of opportunity to interact. So now let me tell you, 2 or 3 things. One is, I have seen that for a lot of people who are outside the country or who have left India and been outside for 20, 25 years and, who make sporadic visits or who hear about India through anecdotes. For them, somewhere what happens is that there are still some parts of India which in their memory or in their mindset might get stored as what it was, when they left the country. So in that journey, what has changed dramatically is interest rate. Look, 25 years back when I started my career in India, Reserve Bank of India used to issue bonds on behalf of the government. We used to popularly call them RBI relief bonds. Now, 25 years back, the interest rate was such that the government of India used to pay 11% tax-free. Today, you will appreciate there is nothing called tax-free and the risk-free rate is 7%. I mean, at that time, State Bank used to pay 9%. The post office used to pay 10% for a monthly interest scheme. Today, those rates are not there at all. So what happens is that structurally, we need to move into capital markets. Structurally, the need to invest in equity. Structurally, the need to assume some risk if you want to generate return. I think that entire thing has changed in the last 25 years. Completely changed. Second thing is there is a proverb in English which says habits change with generations. So today, if you tell a 21-year-old that if you go to the post office, stand in a line, fill a form, they will give you 10%. Even if you give them 10%, they are not going to stand in a line and fill a form. It's not going to be possible. Today, whatever can be done on an app without visiting anybody, and whatever a bank account or whatever broking account or mutual fund account can be opened in the next 30 seconds, that is acceptable. If you tell me to leave my chair and go to somebody's office and fill a form, sorry, that is not going to happen. Correct? So habits have changed, interest rates and the structure of the economy has changed quite dramatically. See, 25 years back, if an entrepreneur wanted to start a business and raise capital, either he would need to borrow from friends and family, or he had to go to a bank or to some informal money lender, or have a subscale IPO, tiny companies doing IPOs, which has no future. But today it has changed. There is private equity, there is venture funding, there is crowdfunding, you name it and we have it. The capital market structure has changed. Correct. And the last thing which I would tell you is the whole technology stack has changed. It doesn't happen in very many countries that with your PAN card and Aadhaar card, you can become my customer in the next 10 seconds. Today you are listening to me, you just hear about WhiteOak mutual fund for the first time, you decide that you want to be my customer, you can go to my website. In 30 seconds, I'll count you as one of my most valued customers. It doesn't take time, right? So I think capital market structure has changed, interest rates have changed, and digitization. And digitization enabled by, the central KYC, the whole unique identification, putting all, the broking, banking, everything is operating on the same stack. So I think these are dramatic transformational changes, and all of this happening exactly when our population is at a bulge, right? 15, 20 years back in India, most people were kids. In the next 10, 15 years in India, most people will be in the prime of their youth. I think a lot of these changes happening along with the demographic shift. That is the, fabulous, it's like a confluence of many, many things happening together. And it is going to be transformational, I think.
I think NRI community will sit up and watch these developments. I can vouch for this. I live in Dubai, but I'm actually coming to India very often. Recent memory that I was traveling from a place called Mangalore to Bangalore, and the street side vendor says no cash, GPay.
Absolutely.
So you can travel length and breadth of country today without having any cash in your pocket, and you have a mobile and everything will happen there. And my maid says, don't call me and send me a message. That's the kind of, see, the level of percolation of technology has happened in India is mind blowing. And instead of India taking from the West, it's the West which is taking from India, which is very visible. But the doubt the NRI community always has, and this is a perennial problem always. See, there are pain points the NRI community will go through. We look at Indian rupee versus the dollar. And 2010, the rupee was at 45. Then there was a bout of volatility which brought down the rupee to 68. It stabilized there, went up to 75. In the recent history of US interest rates going up, it dropped to 80. What do you feel as a fund manager or as an observer of an Indian economy? How will this equation might pan out in the next 5-10 years? Will it be a slow drift down? Will rupee stabilize? Are there any prospects of rupee climbing up? I know that I will not hold you responsible for whatever that happens, but best of best judgment, what do you feel might pan out like?
So, I'll tell you one anecdote from 2008, just a reference point. If you take 25, 30 years, it's true that the rupee has depreciated by about 4% annualized year on year. The problem is exactly that it doesn't happen 4% in a straight line. That's the biggest problem. But what I was referring to, say 2008, I distinctly remember before the global financial crisis started, America was consistently raising interest rates. I think we were in our early 40, 41, 42, 43, something like that, before the crisis started. When Lehman Brothers collapsed and there was massive, and a lot of Indian corporates had foreign borrowings. So when Lehman Brothers collapsed and a lot of Indian companies' foreign loans were called and a lot of outflow of capital from the country, from 41, we collapsed to 48, 49. When the US economy finally collapsed, right? Because see, what will happen is, when US is raising interest rates, the dollar will keep on appreciating. But when they massively raise interest rates, eventually their economy would go into a tailspin and they would engender some kind of landing. You can keep debating soft landing, hard landing. It would engender some kind of landing. So when the economy finally lands or starts cooling off, the dollar would give up its strength because, consistently raising rates strengthens the dollar. But when the economy starts to slow down or it collapses, then they have to cut rates also. Correct? So cutting rates is always followed by the dollar depreciating. So after Lehman Brothers collapse, the rupee went all the way to 38. Okay. Then I'll give you another example. I distinctly remember when there was so-called taper tantrum in 2013 when the US spoke of unwinding the expansion and there was a tightening of monetary policy in the US which was being discussed. As early as August 2013, now we're talking 10 years back. In August 2013, rupee went to some 67 or 68. It just collapsed. Correct? Then for the longest point in time, we were 63 or 64. Till 2018, we were loitering around 63, 64. Correct? So what I'm saying is that, generally speaking, whenever the US is tightening policy, you will find the rupee going into a tailspin. That's why we're at 83, 84. In my humble opinion, in the near to mid-term, say, I don't know whether it is 3 months, 6 months later, but I would put it this way, that anywhere in between the next 12 to 24 months, you will see some amount of appreciating bias according to me. That is quite possible. Whenever you're investing in India's stock market, if you get, let's say there is a correction, now a correction has started because of US. In India's stock market, I can tell you one thing. If you get the Nifty, the market, if you get the market at a PE multiple below 20 times, and if you get a rupee at its extreme, so let us say you get rupee at 84 and you get Nifty at 18,000, for example, you cannot get a better entry opportunity. That is how I would put it. So I think that short to medium term, there is possibly going to be an appreciation bias. That is how I would put it. And longer term investors, I think, you're somebody who's putting money in India's stock market and forgetting for the next 10, 15 years. Your mental accounting should be that you will lose 3 to 4%. Long term, I represent a fund management company. There are others out there. We manage dollar funds. We have funds which are all over the world. People are investing into India. The long-term track record, like say last 5-year track record, in dollar terms will be high double digit, right? So even after losing on the currency, you will still find that dollar basis there is double digit return. So you have to, mental accounting has to be, you will lose 3-4% of depreciation. But I think in the short to medium term, even that is not going to be a challenge. My personal opinion is that we might see some appreciating bias.
Very, very fair points. I personally feel the community always remembers only the pain points, but it will never remember the happy moments. Just to add on to what you said, in the year 2000, rupee to dollar was at 45. And people thought that rupee will only depreciate. Through that massive bull run of 2003 to 2007, people forgot that the rupee appreciated all the way from 45 to 37, 38 rupees per dollar.
Correct.
People also forgot between 2008 to 2021, rupees remained literally flattish at 75 rupees kind of a range. When it remains flattish for a period of time, it's obvious that the economy or the currencies will adjust for the lost time, and it will make an adjustment. People will remember only those pain points, and they think that it is going to be permanently dropping and it's going to be like a Pakistani rupee. India is not Pakistan. People will not understand. See, whenever it drops, makes a huge drops, those are the points of the opportunity. In fact, my audience will remember very well. Many times people trolled also. I said that in one of the videos I had spoken about a rupee at $82, what should the international community do? Where we ask people to invest. Sensex has dropped down to 50 to 53,000 and rupee was at 80 rupees. It was an opportune point. That's exactly what you echoed till now. And probably even in future, this thing will remain. Coming back to the subject again, this brings me to one other question. The perennial problem of India is the capital account deficit. And that's the one which puts pressure on the rupee dollar equations most of the time. Well, yes, with the other problems of inflation, productivity are also something which will have a bearing on this. Is there anything which is really changing? We have seen Make in India, Atmanirbhar, manufacturing of defense required items within India. What do you see as a fund manager might happen to the capital account efficient problem of India? Will it rectify over a period of time? Are there any early green shoots visible in this direction?
I think the government has systematically worked on everything which causes this deficit and everything which causes us to, have high dependence on foreign exchange and, very, very high volatility on the external account. The government has systematically worked on all of this. For example, what is India's oil dependency versus what are the alternate sources of power, right? There is a lot of investment on solar and other alternate modes of power, correct? For every 1% of GDP growth in India, what was the level of oil dependency 10, 15 years back versus what is the level of oil dependency today? Of course, on absolute basis, I'm sure we are consuming more oil. But if you take on a proportionate or a relative basis, that for every 1% of GDP growth, how much oil we are consuming today versus the past, I think oil efficiency has gone up. Alternate sources of power being used has gone up, right? How are we sourcing oil and, how we are conducting our external affairs? I think that has changed quite dramatically. So that is one. The second thing is that in India, apart from oil, the second biggest was, electronics. Whether it is white goods, consumer goods, mobile phones, all forms of electronics. I think there, of course, India has indigenized quite significantly. If you just take mobile phones, we have become a net exporter instead of just being an importer. Correct. Now, today, if you see whether it is the biggest companies, whether, it is Samsung, LG, if you see India's stock market in the last 5 years, by the way, the best performers are people who have indigenized electronics manufacturing into India. All the hotshot companies like Dixon Technologies and Amber Enterprises, etc., they are precisely from this particular segment. So indigenizing of electronics and white goods manufacturing, I think that is another one. Now you can clearly see auto ancillaries, you can see the Teslas of the world setting up at least agreeing to set up their manufacturing base in India. You can see Apple and iPhones and all of those. So clearly we are nowhere in the league of China. But I think that at least whatever was causing huge forex outflow, some of those things the government is working hard to indigenize. And like you mentioned, even defense is part of that. On the other hand, India's share in exports is rising. India's share in, software continues to be the biggest exporter, right? Talent, we are a big exporter of talent, which gives us, foreign remittances of, 100 billion kind of number. So I think the engines of exports, whether it may be talent, whether it may be software and incrementally other areas, the government has put massive, annual 32 billion kind of outlay just to give production linked incentives for ensuring technology and manufacturing in India. So I think this government has systematically worked on everything which was causing headwinds. And I'm quite certain that in the coming year, these equations are going to change significantly.
Thank you very much for those inputs. And when I listen to you, probably it reinforces thought which was there in my mind that these are the changes which will give strength to rupee in the long run. Probably in my personal opinion, I could be wrong or I could be right, or the future will determine. The days of massive rupee depreciation which used to happen in the yesterday years may not happen. The drift can never be ruled out. There are multiple factors which work out. If there is a massive bull market, there is a huge amount of money which can come into India, which can propel the rupee. As you said, in the short term, it may move up. It may revert to the mean. All possibilities are there, but I also personally feel that there are things which are helping Rupee to stabilize this
Yeah.
feeling. Mr. Somaiya, I have one question. You are one of the very rare persons who has worked at the grassroots level with the investors, with the distributors, in the fund managers industry. So you have the experience of the whole gamut of this game. Can you, for the benefit of our viewers, give me a 2-3 thumb rules what an investor should follow, whether it is investing in India, investing in US, or you're here or elsewhere, which I would say cardinal rules of investment.
So, I would say, one of the things which I have learned, I think sometimes, it's all by interacting with investors and, our partners. See, the biggest mistakes which people make biggest mistakes when they are so sure of everything. Correct. So my learning is never be too sure of anything. You can hear me and I can say that maybe the election will bring in continuity. And, we can say that, yes, if the continuity comes, the market will get re-rated. You are not going to get it at this 19,000 kind of levels, etc., etc. But what my learning is that we should always, when we are investing, however educated or best views that we may get, however convinced we ourselves may be about a particular view or sequence of events, what we must ensure is that we are probabilistic. See, however convinced you may be about something, you should still be open to all kinds of possibilities. And that is where having a portfolio which is well balanced. You cannot have everything in debt. You cannot have everything in equity. Within equity, you cannot have every single rupee in India or in US or in the Middle East or anywhere. So your portfolio has to be balanced and it has to reflect all possibilities. If you think that there is a high possibility India will do well, that doesn't mean that you put 100 rupees out of your 100 rupees into India. Correct? That doesn't mean you put 100 rupees in equity. And at the same time, you cannot be of the belief that the world will come to an end. So let me put all my money under a pillow. The world is not going to come to an end. Human beings are not the next dinosaur, but that doesn't mean that trees will go to the sky. So first thing which people should keep in mind, they make the biggest mistakes when they are deterministic about anything. I think for investment success, you should never be deterministic. You should always be probabilistic. I think that will prevent you from making any mistakes. What is the ancillary benefit of this? If you see investment mistakes are made when people react emotionally, greed, fear, anger, envy, these are all emotions. So human beings make mistakes when they are, reacting emotionally. Now the question is, when do people react emotionally? They react emotionally when they are exposed to extreme circumstances. If you have taken risk which you cannot tolerate, you will react emotionally. If you make returns way more than what you ever thought, you are going to react emotionally. So basic point is, first point I would say is that be probabilistic, don't be deterministic. And second point I would say is that never make investment decisions in such a way that it will invoke your emotions. Because the day you get emotional, you are going to make mistakes. I think these two things, if people remember, they'll stay away from all types of pitfalls.
Thank you for those words of wisdom. And I know for sure these have been imbibed by spending those 2 decades of in the Indian economy and interacting with the various segments of the economy. Now let's have a small rapid fire round. I will not hold you responsible for anything, any answers that you give. It's just about being a little bit of a fun. Also to give what your experience speaks about these issues, what the dilemmas people will go through. My first question to you is, should investors invest now or after elections or invest systematically?
They should invest systematically, stagger from now till, few days before the election.
Question 2, 5 years from now, Sensex will be above 1 lakh, below 1 lakh, or too difficult to guess?
Well over 1 lakh.
Question 3, equity investment, invest 100%, don't invest at all, maintain exposure control.
Maintain with exposure control.
Question 4, by 2030, Indian economy will be below 7 trillion USD, above 7 trillion USD.
Close to, in the ballpark of 7 trillion, I would say, close to that number.
So you're just in the vicinity of 7 trillion.
By 2030, yes.
Question number 5. 5 years from now, INR versus dollar will it be below 90, above 90, futile to guess.
No, below 90. I don't think we will reach 90.
In 5 years from now.
5 years from now, yeah, I think because, like I mentioned, in the near term, I think appreciating bias. And 5 years from now, 90 plus minus, but not like dramatically below.
If you were to be an investor, which one will you choose from? A flexi cap fund or a small cap fund?
Flexi cap.
Question 7. By 2030, inflation in India will be below 5%, above 5%, too difficult to guess.
Below 5%.
By 2030, long-term FD rates in India will be below 4%, above 4%, too difficult to guess.
I would say in the vicinity of 5% or so. Say 5%, 4 to 6%, something like that.
That's the broad range.
Broad range, yeah.
So thank you very much for these answers. And I really enjoyed talking to you. And it's a great amount of information for my audience to consume. Thank you very much for your time. And I would love to talk to you again with your words of wisdom and with your experience of the markets. Thank you very much.
Thank you, sir. Thank you for having me. It's my pleasure. Thank you.
Dear viewers, hope the interview with Mr. Ashish Somaiya has been very enriching and very interesting. If it did give you an idea about what's happening in the market, what might unfold in the next few years, please do give me a thumbs up. If you are a person who is watching this channel for the first time, or if you are yet to subscribe for the channel, please press the subscribe button now and press the bell icon. Do not forget to share these videos with all the people who are interested to invest in India. Thank you very much for watching this episode on NRI Money Clinic. I shall be back with you with yet another topic in yet another video very soon.
Press the bell icon for more details and subscribe our channel.